Hello, I'm John A.G. There are moments in markets when the most important developments are not the loudest ones. They don't arrive with panic, they don't come with emergency headlines, and they don't trigger instant reactions. Instead, they unfold quietly, almost politely, in datasets that most people never check. That is exactly what is happening in the silver market right now. Physical silver is leaving one of the most important exchanges in the world, not in a rush, not in a crisis, but in a steady, disciplined flow that signals something deeper than short-term speculation. And if you understand why this matters, you also understand why the smartest analysts in the world are suddenly making forecasts that seem impossible to reconcile. Here is the raw data. Reported silver inventories at the Shanghai Futures Exchange have declined from 573.81 metric tons to 544.24 metric tons. That is a reduction of nearly 30 metric tons in a single reporting period. On the surface, that number may not look dramatic. In a global commodities market, numbers like that are easy to dismiss. But the significance is not the size of the decline alone. It is where the decline is happening and what that exchange represents. The Shanghai Futures Exchange is not just another pricing venue. It is one of the most important physical delivery points in the global silver system. When metal leaves those vaults, it is not being repositioned on a spreadsheet. It is being absorbed by real demand. This is where silver separates itself from most financial assets. Silver is not just stored, traded, and forgotten, it is consumed. Gold largely remains above ground, preserved as jewelry, investment bars, or central bank reserves. Nearly all the gold ever mined still exists in some form. Silver does not enjoy that luxury. Silver is used up. It disappears into solar panels, electronics, electric vehicles, medical devices, and advanced manufacturing processes. Once silver enters many of these applications, it is never economically recovered. That means inventory levels are not just a statistic. They are a measure of how much usable supply remains available to the market. When nearly 30 metric tons of silver leave Shanghai inventories, that metal is not waiting to be sold back at a higher price. It is moving into factories and supply chains where it becomes part of products that power modern economies. This is not leverage. This is not speculation. This is physical silver being removed from circulation. That distinction is critical because it explains why experienced market participants monitor Shanghai data even when Western markets appear calm. China's role makes this even more important. China is one of the largest producers of silver in the world, and at the same time one of the largest consumers. That dual position gives Chinese inventory movements outsized significance. When inventories decline in Shanghai, it can signal rising domestic consumption, constrained supply, or both. Either way, it has global implications. Silver that is consumed domestically is silver that does not reach international markets. That changes trade flows, availability, and ultimately pricing dynamics elsewhere. Unlike many Western futures exchanges where contracts are routinely rolled and rarely settled with physical delivery, the Shanghai Futures Exchange is tightly linked to real metal flows. Silver moving through Shanghai is closely connected to industrial users. When a manufacturer needs silver for photovoltaic cells or electronics production, that demand pulls from physical inventories. The nearly 30 metric ton decline represents actual metal leaving storage and entering productive use. That is why this signal matters. This brings us directly to the industrial demand story, which now sits at the center of the silver market. Silver's physical properties make it difficult to substitute. It has the highest electrical conductivity of any element, exceptional thermal conductivity, antimicrobial characteristics, and reflective properties that are critical in advanced technologies. In applications where efficiency and reliability matter, silver remains irreplaceable. Cost considerations often take a backseat to performance. Solar energy illustrates this perfectly. Photovoltaic cells rely on silver paste to conduct electricity generated from sunlight. Every solar panel installed anywhere in the world contains silver. As governments subsidize renewable energy, corporations commit to net zero targets, and utilities expand solar capacity, demand for silver increases alongside it. China leads the world in both solar manufacturing and deployment. That leadership translates directly into sustained domestic silver consumption. Electric vehicles add another powerful layer of demand. Compared to internal combustion vehicles, electric vehicles require more silver due to their complex electrical systems, battery management units, power electronics, motors, and charging infrastructure. As the global vehicle fleet continues to electrify, silver demand scales with it. This is not a future possibility. It is already happening across millions of units. Beyond solar and EVs, silver plays a crucial role in semiconductors, data centers, telecommunications infrastructure, medical equipment, and consumer electronics. The digital economy depends on silver at a foundational level. As that economy expands, so does the underlying demand for the metal that enables it. This is why many analysts now describe silver as both a precious metal and an industrial metal. Its demand profile is no longer tied solely to investor sentiment. One consequence of this reality is that silver supply is constantly being depleted in ways gold is not. Silver embedded in electronics, infrastructure, and medical devices is rarely recycled because recovery is not economically viable. Each year, a portion of newly mined silver permanently exits the available supply pool. When industrial demand rises alongside investment demand, inventories tighten quickly. That is when drawdowns begin to appear. Additional signals confirm this tightening. Silver premiums in China have risen to roughly 10% compared to prices in London or New York. In a smoothly functioning global market, such discrepancies would be arbitraged away. Traders would buy silver in lower-priced markets and sell it in higher-priced ones until prices converged. The persistence of this premium suggests that supply constraints or logistical frictions are preventing that process. Importantly, this premium remains even after accounting for China's 13% value-added tax, underscoring the strength of local demand. Lease rates provide another piece of evidence. Implied lease rates for physical silver are elevated near 3%. Lease rates represent the cost of borrowing physical metal. In a well-supplied market, these rates hover near zero because metal is easy to source. When rates rise and remain elevated, it signals scarcity. A sustained rate near 3% indicates that physical silver is not effortlessly available. That is not a speculative signal. It is a physical one. Research firms have explicitly highlighted these conditions, noting that elevated lease rates and record premiums are consistent with a fundamentally tight market. These are not the characteristics of abundance. They suggest stress beneath the surface, even if price action appears orderly. All of this sets the stage for the extraordinary divergence now visible in analyst forecasts. Some institutions argue that silver prices could surge dramatically, while others warn of sharp declines. Both sides are examining the same data. The disagreement does not come from ignorance. It comes from uncertainty about what happens next. In the next part, we will explore these opposing forecasts in detail, explain why credible analysts can reach such different conclusions, and begin building a framework for navigating a market where extreme outcomes on both sides are suddenly plausible. To understand why silver forecasts have become so extreme, you need to recognize that the market is currently being pulled in two opposing directions at the same time. On one side, the physical market is sending signals that supply is tightening. On the other, price behavior and positioning suggest that expectations may have moved too far too fast. This tension is why respected analysts are arriving at conclusions that appear mutually exclusive. They are not looking at different markets. They are interpreting the same evidence through different lenses. The bullish case begins with momentum and physical demand. Citi has stated that silver prices could rise to as high as $150 per ounce within the next 3 months. That projection implies a gain of more than 30% from current levels over a very short period. The reasoning behind this view is not simply enthusiasm. It is grounded in the belief that Chinese buying is providing a powerful tailwind and that silver is behaving like gold with leverage. When gold moves higher, silver often moves faster because its market is smaller and more sensitive to incremental demand. This idea of silver acting as gold amplified is not new, but it becomes especially relevant during periods of monetary uncertainty. Gold itself is benefiting from strong institutional support. Goldman Sachs has highlighted meaningful upside risk to its gold forecast of $5,400 per ounce by December. If gold were to exceed that level, the implications for silver would be significant. Deutsche Bank has taken the argument further, suggesting that gold prices closer to $6,900 per ounce would better align with the metal's performance trend over the past 2 years. Other major institutions have issued forecasts that cluster around similar territory, reinforcing the view that gold may still be undervalued relative to macro conditions. These projections matter because of the relationship between gold and silver prices. The gold-to-silver ratio has compressed to the low 40s, a 4-year low. At those levels, if gold were trading near $6,000, silver would need to be priced near $140 simply to maintain the existing ratio. In past precious metals bull markets, that ratio has often compressed even further as silver outperformed. Under that historical pattern, silver prices above $150 would not be mathematically implausible. From this perspective, aggressive bullish forecasts are not predictions pulled from thin air. They are extensions of existing relationships under current assumptions. However, the bearish case challenges those assumptions. Some analysts argue that the recent surge in silver prices reflects speculative excess rather than sustainable demand. Marko Kolanovic, formerly J.P. Morgan's chief strategist and co-head of global research, has warned that silver prices could be halved later this year. That would imply a fall from levels above $100 to the $50 or $60 range. Such a move would be severe, particularly for participants who entered late in the rally. The bearish argument rests on two pillars. The first is the expectation that supply tightness will ease. Higher prices incentivize increased production, improved efficiency, and substitution where possible. Over time, these responses can alleviate shortages. The second pillar is the belief that industrial demand growth, especially from China's solar sector, may be nearing a peak. BMI has explicitly stated that demand for silver from China's solar industry has likely already peaked. If that assessment is correct, one of the most powerful drivers of physical consumption could be shifting from acceleration to deceleration. This distinction is subtle but crucial. Markets often respond more strongly to changes in growth rates than to absolute levels. Demand does not need to collapse for prices to adjust. A slowdown in growth can be enough. If silver demand continues to rise but at a slower pace, inventories may stabilize, premiums may compress, and price pressure may ease. That scenario would undermine the justification for extreme valuations. Valuation concerns add another layer. Silver now appears expensive relative to gold by historical standards. With the gold-to-silver ratio at a multi-year low, silver has already captured a significant portion of the upside from macro factors such as dollar weakness and geopolitical uncertainty. Bears argue that much of the good news is already priced in. If macro conditions stabilize or reverse, silver could be vulnerable to a sharp correction. Technical indicators reinforce this caution. Momentum metrics such as the relative strength index are firmly in overbought territory across multiple timeframes. More concerning is the appearance of a daily RSI divergence, where prices continue to make new highs while momentum weakens. This pattern has historically preceded corrections or periods of consolidation. It does not guarantee an immediate decline, but it does increase risk for those entering at elevated levels. Supporters of the bullish view counter that technical signals are less reliable when physical constraints dominate. Overbought conditions can persist longer than expected when supply is genuinely tight. If inventories continue to decline and premiums remain elevated, price weakness may be limited. From this angle, waiting for a technical pullback may result in missed opportunity rather than improved risk-reward. This disagreement illustrates the core challenge facing market participants. Both sides are making reasonable arguments based on real data. Bulls focus on physical flows, industrial consumption, and macro tailwinds. Bears focus on valuation, momentum exhaustion, and the possibility that demand growth is peaking. The market sits at the intersection of these forces, and the outcome depends on how they evolve. When credible analysts disagree this sharply, it usually reflects genuine uncertainty rather than incompetence. No one knows with certainty whether Chinese industrial demand will continue expanding at the same pace, whether monetary policy will loosen further, or whether global economic conditions will deteriorate or stabilize. These unknowns drive the wide range of forecasts. In such an environment, the most effective approach is not prediction but preparation. Position sizing becomes critical. Exposure should be calibrated so that adverse scenarios are survivable. If a 50% decline in silver would cause severe financial or emotional damage, the position is too large. Reducing size does not mean abandoning conviction. It means respecting uncertainty. Planning ahead also matters. Decisions made in advance tend to be more rational than those made under pressure. Knowing how you would respond to both upside and downside scenarios reduces the likelihood of emotional reactions. This includes identifying levels where profits might be taken or exposure reduced, as well as conditions under which additional exposure might be justified. Focusing on objective indicators rather than narratives is equally important. Stories about silver shortages or price explosions can be compelling, but they are not substitutes for data. Inventory levels, premiums, lease rates, and price behavior provide continuous feedback about market conditions. These indicators often change before narratives do. It is also essential to remember that silver is part of a broader precious metals complex. Gold, platinum, and palladium are all responding to similar macro forces. Silver's outsized move reflects its leverage to those forces, but that leverage works in both directions. Greater upside potential comes with greater downside risk. In the next part, we will step back further to examine the macro environment shaping precious metals, explore the role of dollar weakness and geopolitical uncertainty, and lay out a disciplined framework for navigating a market where opportunity and risk are unusually elevated. To fully understand the position silver occupies right now, it helps to zoom out and view it within the broader precious metals landscape. Silver is not moving in isolation. Gold, platinum, and palladium have all posted strong gains this year, indicating that what we are seeing is not a single market anomaly, but a broader reallocation toward tangible assets. Gold has gained roughly 22%, platinum approximately 28%, and palladium close to 19%. Silver's 58% rise is exceptional, but it fits within a larger pattern shaped by currency weakness, political uncertainty, and shifting confidence in monetary systems. The most immediate driver behind this movement has been the decline of the US dollar. The dollar has weakened to levels not seen in around 4 years. On a mechanical level, a weaker dollar supports higher commodity prices because more dollars are required to purchase the same quantity of metal. But the significance goes deeper than arithmetic. Currency weakness reflects concerns about fiscal sustainability, political direction, and long-term monetary credibility. When confidence in fiat systems erodes, capital historically seeks refuge in assets that exist outside those systems. Gold and silver have served that role across centuries of financial history. Political uncertainty has reinforced these dynamics. Inconsistent policy signals, unresolved geopolitical tensions, and shifting international relationships have increased demand for perceived safe stores of value. Research agencies have noted that uncertainty surrounding U.S. policy positions remains supportive for precious metals. Statements suggesting tolerance for a weaker dollar have further fueled concerns about devaluation. When leaders of reserve currency nations appear unconcerned about currency strength, markets take notice, precious metals respond accordingly. Gold's elevated price environment provides a stabilizing anchor for silver, even when silver-specific factors fluctuate. Research firms have raised gold price forecasts significantly, with projected ranges between $4,500 and $5,500 per ounce in the near term. Some institutions suggest even higher levels if current trends persist. These expectations support the broader metals complex. Silver's volatility reflects its smaller market size and industrial exposure, but its trajectory remains linked to gold's macro role. Silver's dual identity is what makes it uniquely complex. It responds to the same monetary forces as gold, while also being subject to industrial demand cycles. These two drivers do not always align. At times, industrial demand may soften even as monetary demand strengthens, or the reverse. The current debate revolves around which force will dominate in the months ahead. Bullish participants emphasize physical constraints. Declining inventories at the Shanghai Futures Exchange, elevated lease rates near 3%, and sustained premiums approaching 10% all point toward tight physical supply. These are not paper market signals. They reflect real metal being absorbed by real demand. If these conditions persist, price corrections driven by speculative positioning may be limited. Bearish participants focus on adaptability and valuation. They argue that higher prices incentivize increased production, substitution, and efficiency improvements. Over time, supply responses can ease tightness. They also emphasize the risk that industrial demand growth, particularly from China's solar sector, may slow. Even if absolute demand remains high, decelerating growth can change market psychology and pricing dynamics. China remains the fulcrum of this debate. Bulls highlight China's continued investment in renewable energy, electrification, and advanced manufacturing. These initiatives are strategic and long-term, not easily reversed by short-term economic fluctuations. Even modest growth in these sectors translates into substantial silver consumption due to their scale. Bears counter that growth rates matter more than totals. If solar deployment grows at a slower pace than before, incremental demand declines. Markets often react to changes in momentum rather than levels. A transition from rapid growth to moderate growth can pressure prices even if demand remains historically elevated. This is why the question of whether Chinese solar demand has peaked carries such weight. Ultimately, this uncertainty cannot be resolved through argument alone. It will be resolved by data. Continued inventory drawdowns, elevated premiums, and sustained lease rates would support the case for ongoing tightness. Stabilizing inventories, narrowing premiums, and easing lease rates would suggest supply and demand are rebalancing. These signals tend to shift before narratives adjust. Technical analysis adds another layer of context. Overbought indicators and momentum divergences warn that risk has increased. They do not predict timing, but they caution against complacency. Strong trends can persist despite overbought conditions, especially when fundamentals are supportive. At the same time, ignoring technical signals entirely can expose participants to unnecessary drawdowns. The balanced approach is to respect both structural forces and market behavior. Risk management becomes the central discipline in this environment. The objective is not to predict exact price outcomes, but to remain positioned across a range of plausible scenarios. That starts with position sizing. Exposure should be set so that even extreme adverse moves are survivable. Volatility tests discipline as much as conviction. Oversized positions magnify emotional stress and impair judgment. Predefined plans are equally important. Knowing in advance how you would respond to significant upside or downside reduces the likelihood of reactive decisions. These plans should be based on observable conditions rather than price targets alone. Data-driven adjustments tend to be more effective than emotional reactions to headlines. Diversification within the precious metals complex can also mitigate risk. While gold, silver, platinum, and palladium often move together, their drivers are not identical. Balancing exposure across metals can smooth volatility while maintaining participation in broader trends. Time horizon alignment matters as well. Short-term traders face different risks than long-term holders. What appears extended on a daily chart may be irrelevant over a multi-year horizon. Conversely, Long-term narratives do not protect against short-term corrections. Clarifying time horizon helps determine which signals deserve the most weight. The silver market currently presents a rare combination of opportunity and uncertainty. Forecasts range from dramatic upside to severe downside, and both extremes are supported by rational arguments. This does not mean the market is unknowable. It means humility is required. Recognizing uncertainty is a strength, not a weakness. The most consistent edge comes from observation rather than prediction. Inventory levels, premiums, lease rates, price behavior, and macro signals collectively tell the story of supply and demand in real time. Adjusting exposure as that story evolves is more effective than committing to a single forecast. Markets have always transferred wealth from the impatient to the patient, from the emotional to the disciplined, and from those who chase certainty to those who manage uncertainty. Silver's next move will reflect forces larger than any individual opinion. Whether prices move dramatically higher or correct sharply, the principles of discipline, risk management, and data awareness remain constant. Your role is not to forecast perfectly. Your role is to remain adaptable, rational, and prepared. Let the data guide your decisions, respect both opportunity and risk, and allow the market to reveal its direction in its own time.